If you've ever heard someone say you should set up an S Corp to save on self-employment tax, it's actually good advice with an important catch. Part 3 of 4 in our business entity series, how S Corp taxation works and what you have to get right to make the savings stick. First, an S Corporation is a tax election, not a business type. An LLC or a corporation can elect S Corp treatment by filing Form 2553 with the IRS. The entity still exists under state law, but the IRS treats it differently for tax purposes. S corporations are designed for small businesses. They're limited to 100 shareholders, and all shareholders must be U.S. residents or resident aliens. No corporations or partnerships are allowed as shareholders. Like a partnership, an S Corp has pass-through taxation. Business income flows to the owners through Schedule K-1, and there's no entity-level income tax, no double taxation. That part is straightforward. The key benefit is what happens with self-employment tax. An S Corp owner who works in the business must pay themselves a reasonable W-2 salary. Payroll taxes apply to that salary just like any other employee, but distributions above that salary can be taken out of the business without being subject to self-employment tax. And at a 15.3% self-employment tax, that can add up fast. Here's where the IRS pays close attention. You can't pay yourself a token salary of $10,000 and take everything else as distributions to avoid payroll taxes. The salary has to be reasonable, meaning comparable to what you would pay somebody else to do that work. If it isn't, the IRS can reclassify those distributions as wages and you'll owe the taxes plus penalties. Form 2553 has strict timing rules. Generally, it needs to be filed by March 15th to be effective for the current calendar year or within 2.5 months of forming a new entity. There are some options to request it after that, but you have to have a reason. And the savings have to outweigh the costs. If you're a sole proprietor and you elect S Corp status, you're now running payroll, you're filing a separate business entity return, and you're paying for both of those things. Those are real costs. If your profits are thin, the math might not work in your favor. Check in with your tax advisor to ensure it makes sense before you add the overhead. And that's the S Corporation, real tax savings with real rules attached. Hit like if this helped clarify how S Corps work, and check back next week to learn about C Corporations.